Hello friends, today we are going to discuss basics of capital gain in this video. Let's start with section 45, which is the charging section of this chapter. So it says there must be a capital asset and there must be a transfer of such capital asset in the previous year. If a capital asset is transferred, then we will compute the capital gain. So if an asset is not a capital asset or if a transfer is not a transfer as per income tax act, then we will not calculate capital gain. Okay. So now let's understand what is the meaning of capital asset. So government says any kind of property, whether tangible, intangible, movable, immovable, used for business profession or personal asset. Any kind of property is a capital asset. So obviously the meaning is quite comprehensive. So exceptions have to be there. So there are three exceptions, main three exceptions. First one, movable personal effects. So if you are transferring your car or clothes or watches or utensils, etc., which are used as personal assets, then you're not supposed to compute capital gain. Logic is very simple because these value of these assets actually depreciates with time. So they will result in capital loss only. So government doesn't want to even compute capital gain. But there are certain assets value which appreciates with time. That is jewelry, archaeological collections, drawing, paintings, sculptures, any work of art. So if you transfer Jadapsa, we can call them Jadapsa. If you transfer Jadapsa, you need to calculate capital gain. If you transfer other personal assets, you are not supposed to calculate capital gain. Okay. Second exception is rural agri land in India rally. So if you transfer urban agri land, you need to calculate capital gain. If you transfer rural agri land, you're not supposed to calculate capital gain. Third one is stock in trade, which is very obvious because when you transfer stock, you pay tax in PGP, in business profession. Why should you pay tax again in capital asset, in capital gain as capital asset? So that's why it is also listed in exceptions. So MRS misses. So if you are transferring misses, you're not supposed to pay capital gain. Possibly inspired from Mahabharat, they uh, came to this conclusion. I'm joking. Then there are certain securities like bonds, national defense bonds, special bearer bonds, gold deposit bonds, which are not so important from exams point of view, so you can ignore them. But I'm just giving you for a reference. Okay. So if you transfer these assets, you are not supposed to compute capital gain. Some two three special points. I want you to pay attention. Securities for FIIs will not be treated as stock in trade. That means they have to pay capital gain if they transfer securities. It is beneficial for them. We want them to invest more in Indian capital market. That's why we are alluring them so that they invest more in securities. They have to pay tax at lesser rates, lower rates. That's why. Second one is sovereign gold bonds are not covered under exceptions. Just take care. And third one, if you transfer management rights or control in any Indian company, you have to pay capital. You have to compute capital in India uh, from anywhere in the world. Okay, in any manner, directly, indirectly. After Vodafone's case, this has been entered as explanation in the definition. So this is the definition of capital asset. Okay. Now the definition of transfer, it is again very comprehensive. Basic case is sale. Obviously, we understand transfer. We normally, like in common parlance, we understand transfer as sale only. Okay, in form of sale only. But there are other certain transfers like exchange, relinquishment, to relinquish, to renounce, extinguishment of any rights in any capital asset. If you transfer your capital into stock in trade, that is also a kind of transfer. If your property is being compulsory acquired by government, again that is a transfer. If you if you are maturing a zircon bond, that is also a transfer. Okay, even if you transfer possession of a property in part performance of a contract, like deed is pending but agreement has been done, advance has been paid, again you need to calculate capital gain. And two more things just to again make this definition comprehensive. Any transfer which has the effect of transferring or enabling the enjoyment of any immovable property, or if you're transferring interest in any asset, like disposing of parting with an asset or interest therein, still you are transferring. So you need to calculate capital in all such cases. We are going to discuss only sale in this video. Other cases are discussed in detail in special cases. Okay. So if you are transferring a capital asset, you need to calculate capital gain. Okay. Now next thing, types of capital asset. So there are two types of capital assets. First one short term, other long term. So if the period of holding of a capital asset is up to 36 months, then that asset is called as short term capital gain. And in case of transfer of a short term capital asset, the capital gain is called as short term capital gain. Okay. In case of Other assets, you need to calculate long-term capital gain. That means if the period of holding is more than 36 months, then you need to calculate long-term capital gain. That asset will be called as long-term capital asset, and in case of transfer of long-term capital asset, we need to calculate long-term capital gain. But there are certain exceptions. Like in following cases, replace 36 months by 12 months. Okay. So first one, listed shares and securities, okay, except units. So if you transfer listed shares, listed debentures after 12 months, then the gain is long term, otherwise the gain is short term. If you transfer units of UTI or units of equity oriented mutual fund, then you need to calculate long term capital gain, the if the asset has been held for more than 12 months, otherwise short term capital gain. One thing you can just take care here, debt oriented mutual fund are not covered. That means if you transfer debt oriented mutual funds units, then that will be covered under 36 months category. Okay, or like any other, like units of business trust also are covered under 36 months category. Zero coupon bond, if you are transferring after 12 months, then long term, otherwise short term capital gain. So you need to learn these three things precisely. And again, in 24 months category, there are two things. First one is unlisted shares. Just again take care, unlisted shares. It is not written unlisted shares and securities. So if you transfer unlisted debentures, then 36 months category will be applicable. Whereas if you transfer unlisted shares, then it will be got under 24 months category. Okay. Again, units are not mentioned here. And in case of land and building, if you transfer immobile property in short, then after 24 months, that is long term, otherwise short term. Okay, I've given some examples here. You can use them as directory, like if you have some doubts. Okay, and just put your doubts in comment section in case it did not serve the purpose. I just want to point out 14th and 15th point. Just see, golden utensils for personal use are to be treated as capital asset, whereas silver utensils are not to be treated as capital asset. Okay, these are because of two case studies. Okay, just take care. Now some examples. Mr. X purchased a gold ring at 1 lakh, sold at 5 lakhs, purchased in 18, sold in 19, improved the gold ring in 18 only by spending 20,000 rupees, and spent more 20,000 rupees just to transfer, say brokerage he paid. Compute capital gain. First of all, the gain will be short term because the period of holding less than 36 months. Okay, please ignore this distraction. Second, you need to calculate it normally only because you can see at 5 lakhs you are sold, 20,000 rupees you have spent uh, for transferring the same. So in hand you got 4 lakh 80,000 rupees. You had bought this asset at 1 lakh. You had spent 20,000 rupees for improving that ring. We can assume this as a capital expense. So technically you earned 3 lakh 60,000 rupees from this transaction. Okay. So short term capital gain is nothing but a simple calculation of buy sell transaction, nothing more than that. Okay. Next, what if the ring is purchased on 1/7/2001 and improvement was also done in 2001 only? So again, now it is a case of long-term capital gain because the period of holding is more than 36 months. So now one problem will arise that your net consideration of 4 lakh 80,000 is of 2019-20. How can you compare 1 lakh rupees of 2001, that is cost of acquisition of 2001, with 2019-20's net consideration? Because during this period of say some 19-20 years, obviously the money has lost its time value, and opportunity cost of the assessee will also be considered. So government says yes, we'll give the benefit of time value of money and opportunity cost lost by way of indexation. So to give you indexation benefit, like of inflation's benefit in due to uh, 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 inflation and other things like in cost, so on the basis of CPI, government has come with a new index called as cost inflation index, that is CII. So it will guide you, it will help you to calculate index cost of acquisition, which will be deducted there from net consideration. Okay, and current base year is 2012. Okay, so consumer price index will help you to calculate cost inflation index It is some 75% of CPI, CIIs, but you are not concerned with that thing. And it is rising, and currently it is 289 in 2019 20. So we can say 1 rupee of 2012 has become 2.89 rupees of 2019-20. So 1 lakh rupees of 2012 will become 2 lakh 89,000 rupees of 2019-20. Same way we can index our cost of improvement also, and this way we'll calculate long-term capital gain. Okay. So now again one more problem can arise there if the asset has been acquired before the base year. That is, say in this question, if the ring was purchased in 1960, then what will be the case? So again a problem will arise that up to net consideration it is okay, but how should we index that cost? Because we don't have CII of 1960, because government has already set the base year as 2012. So the problem is we have cost of 1960, we have CII of 2012. So either we can take cost to 2012 to compare, or we can take CII to 1960. Government says we are not going to take CII to 1960. So obviously government will have to give benefit of 2012's price. So government is right to assume that that asset has been acquired on 1/4/2001, because they are giving you benefit of index of 2012. So that's why assessee can take FMV as on 1/4/2001 as cost of acquisition. Again, as I said, it is an option. So assessee will take FMV only if it is higher than the actual cost. So in this case, we can see the FMV is 2 lakhs and actual cost is 1 lakhs. Obviously, assessee will take 2 lakhs. So 2 lakh multiplied by 289 divided by 100. So this is your index cost of acquisition in case asset has been acquired before 1/4/2001. Now, special thing. Index cost of improvement will not be allowed if improvements have been done before 2001, because government is saying when we have already given you the option of improved houses FMV, not house, improved assets FMV, okay, to take as cost of acquisition, then why should we allow you again to deduct cost of improvement? Okay, so this is, I'm just deriving logic. Government is not given any logic. They have simply given that ignore index cost of acquisitions, yeah, sorry, index cost of improvements or cost of improvements if improvements had been done before 2001. Okay, so we are going to take it as nil, and this way you can calculate your short-term capital gain or capital loss. Okay, I'm giving all the formats like how to solve, but still I don't think these are needed. That's why we have solved the examples before the formats. Okay, I'm giving you all the formats also, like index cost of acquisition, how to calculate index cost of improvement, how to calculate cost if it is being acquired, if the asset has been acquired before 1/4/2001, and we have to ignore cost of improvement if improved before 1/4/2001. Okay, one more example we are going to solve. It is of sale, and it involves three improvements. Okay, let's see. Mr. X bought house at 1 lakh in 2021. In 4041 he constructed. See, now this improvement we are going to ignore. Okay, then to the 1 2 again improved. This will consider. FMV is given. FMV is 5 lakhs. Actual cost was 1 lakh. So obviously we will take 5 lakhs. Okay, whichever is higher. 1819 again improvement we'll consider, and finally sold the house at 20 lakhs and went on world tour. We are not concerned where did he go. Okay, so FPOC is there, transfer expenses are not there, so NC is 20 lakhs. Okay, cost of acquisition 1 lakh or 5 lakh, which is higher? 5 lakh, we'll take 5 lakhs, and then we'll multiply 5 lakhs by with 289 and we'll divide by 100. Okay, so this is how we calculate index cost of acquisition, because again the asset was acquired before 1/4/2001. That's why we compared. Otherwise, we are not supposed to compare. We will take actual cost only in other cases. Then improvement of 4041 will be ignored because as discussed. And then in 2001 to again improved will give the assessee benefit of index cost of improvement, and again of 1819 will take the improvement into consideration. You can see I multiplied 289 and we have divided 280. Okay, why 280? Because it is the index of year of improvement. Okay, just take this in mind, and this how we can calculate long-term capital gain in case the question has multiple improvements. Okay, so I hope This video will help you to understand all the basic things in fast manner. Please revise it again if I went too fast. Okay, and just write down your doubts in the comment section. I'll try to solve them as soon as possible. Thank you so much for watching.